All right, everybody, let's try to break down some crypto here today. A lot of headlines on Bitcoin, which is, of course, the leading cryptocurrency, and questions from people from different age divisions and situations on, what is this stuff and whether or not this is like some gimmick or, what the viability about Bitcoin and the other cryptocurrencies, and whether or not it really has any, fit for your portfolio, for your situation, whether or not it's possible, whether or not this is preferable, et cetera, et cetera. So I'm just going to give you some overviews on the main rationales on, what's driving this and my opinions about, Bitcoin under different time horizons. Okay, so with that in mind, let's just get started. So first of all, the question is what is cryptocurrency? And for me, the key thing for you to know is the fact that there's a term called blockchain. Blockchain, okay? And what blockchain basically is, in a nutshell, it is an electronic time and date stamp, one which cannot be stolen. It permanently embeds any transaction that deals with cryptocurrency. So, for example, I send half a Bitcoin to a website as a donation, which is be $14,000. So no, that's not going to happen. But you understand my point. That transaction from me to that website will have a date, a timestamp, an indelible timestamp, one that cannot be erased. And now you can understand its appeal, which is, since it can't be forged, and there are going to be hacks around this, and there's going to be news around the hacks around it. Don't get me wrong. But basically, that technology basically makes it like no other currency that exists today, right? I can forge a US dollar. I can forge a euro bill, all right? If you watch The Money Heist, which is, a Netflix series, a very popular one, the whole premise is the fact that you're going into the mint of the Bank of Spain in that instance, and you are basically printing your own dollars. You can't do that here in crypto, okay? The second part of that is that there's basically a fixed supply. You don't just get to take the government to just increase the number of dollars, which is absolutely happening here, right? In the real world, based on, the pandemic, for example, and even prior to the pandemic, you have basically had central banks literally printing money, creating money just by hitting the print button at the central bank level. That cannot really be done for cryptocurrency. So as a result, you will be able to see the huge number of ripple effects that this has when you compare it to any other financial asset. So number one, it's secure, and number two is that there's a limited supply. And that is true across the board for the most part. That is true. We'll get on to the second section. So what I'm going to do here is I'm going to break this up in little bits so I don't try to leave something out that's important, and also try to keep them into bite-sized morsels that everyone can understand. Let's move on. As a result of the limited supply, you can see, for example, if you go on Google, you can see something called Bitcoin mining. And so what ends up happening is the super smart nerds are sitting there with humongous computing power, sitting and using up tremendous amounts of electricity to be able to figure out a mathematic equation in order to get out a Bitcoin. Basically, that's what it is. The only way to create Bitcoin then is to solve a mathematic algorithm that cannot be done on a piece of paper, but requires tremendous computing power. Tremendous computing power. So much so that, the electronic bill, the bill for the electricity may be greater than the amount of money you would make from a Bitcoin. Now, that hasn't occurred, right? So to those people who are doing this, you have Bitcoin mining occurring to some degree. Nevertheless, it is not the same as central bank just hitting the print button to create, trillions of euros, trillions of yen, trillions of US dollars or yuan. That does not happen when it comes to cryptocurrency. That has tremendous ripple effects, right? Because of the fact that there is a constrained known supply for the most part. All you have is demand on a limited amount of supply, therefore pushing the price up. So that by itself tells you what's going on, which is supply constrained, demand building. Simple as that. Simple as that. Let's keep going. I mentioned the fact that since supply is constrained compared to the central banks, the global central banks, which is basically in order to deal with the housing crisis, in order to deal with and the ripple effects of the stress that it has taken on the banking system. Right. In other words, you've had to have central banks basically printing money, whether that be issuing bonds, whether that be then buying back the bonds with their own money, which is all sorts of crazy contorted combinations, something that a household you would never, we cannot do, at a household level. Only the government can do. The results of all of that, however, is a fact that we now have a macroeconomic problem to which we don't have a roadmap. We have no roadmap out of this problem. Meaning that because of the fact that the central banks have continued to print money and continue to do so now, right? I mean, you can see the debate on stimulus, et cetera, which is just another form of that. You're going to have to issue debt in order to create the money, in order to send out a stimulus check. This money is not going to appear. Somebody has to start printing, right? Now, this is a known fact. This is not, I am not some groundbreaking macroeconomist, right? But what it's trying to do here is to give you an idea about the scope and scale. Because of the fact that this has been going on and that we have no roadmap, we do have, historic precedent. But the issue here is that the solution out of it, from a history's point of view, is not a positive one, because the anecdotal evidence, the historical evidence about the way out of this situation is financial calamity and hyperinflation. And so you can see this. You can see elements of this today. So the way that the world is working currently, and it has been for some time, is basically a contest of, my currency is worth less than your currency. So, for example, right now, the US dollar trades at 1.2 euro. Okay. 1.2 euro can be redeemed, you get $1. Well, this is substantially weaker for the US dollar. Well, that's all okay. And the theory here is that weaker dollar make U.S. exports more attractive, more competitively priced on the international market level. The negative to that is the fact that when you try to change your dollars into, a Mercedes, the problem here is that your dollar doesn't go as far. So you're trying to buy an import. And that import can be anything, right? So if you're trying to buy something that started in Europe, that was manufactured in Europe, you're going to have an issue. And, it's marginal now, right? It's marginal now. But now all of a sudden, instead, let's just call it 1.2 euro to the dollar to 2 euro to the dollar. Okay, now your Mercedes is not $50,000. It's now $90,000. Okay, and I'm making it up. I didn't do the math and stuff like that. But you can see what is the problem. Is that now, as a result of a weaker U.S. currency, you will have inflation for everything that you have to import. All of it. So what you have is some very delicate game of chicken. Very delicate. Which is that the U.S., and every country is trying to do this. Basically every country. Right, is a countries that are trying to export their way and get money in order to pay for the debt that I just talked about because of the printing press. You need to push down your currency. If you keep pressing down on your currency, you're opening the door to the possibility of hyperinflation. And now you can go on hyperinflation on Google and see, you see small African countries, right? Zimbabwe, I want to call it, right? Where it starts to run out of control. In which case, now the people can't buy anything. United States, European Union are not Zimbabwe. Don't get me wrong. Okay, so this is not that. Nevertheless, it does illustrate the fact that because you've got such a huge debt problem, and because of the fact that hyperinflation could be one way, the only historical way out of this situation, now you can understand the feedback loop to crypto. Because since no government can hit the printing press, what you have is possible inflation and hyperinflation, right? You have lower fiat currencies, and fiat currencies is the fancy, snobby way of saying, US dollar, euro, yen, yuan, which is the government sanctioned currencies, leaving cryptocurrency and historically gold. Right? That the rationale that I'm describing here is in fact gold. Right? It is the store, and this is then another fancy financial term, store of value. Right? That since the central banks don't have control over the actual number of supply of crypto, of gold, basically what happens is under hyperinflation, in theory, you could have the prices, the nominal prices as denominated in dollars or denominated in euro, notably higher. Now, this, do I lose any sleep today that we're going to go to hyperinflation tomorrow and then all of a sudden we are in shantytown in the United States? No, I don't. I do not. Right. This is still the fact that the United States is the most flexible economy. I don't think there's any question. There should not be much debate about it. That all said, are there structural problems that I've just described? Yes. And are they worse? Yes. They're worse than this. Yes. We will get to that, in the coming segments. But I'm gone through this long-winded explanation in order to tell you, to give you what the backdrop here. So the idea that crypto can immediately go away, or that this is hocus pocus, probably not correct. Probably not correct. We'll get on to some technical details about what I'm seeing next. So I've given you the backdrop for the most part, right, about what the economic theory of a new type of non-fiat currency looks like. And as I said, this is not news to those of you who understand why people buy gold. Okay. The negative, of course, to these instruments is that they do not, there's no yield, meaning that they do not, pay interest. So, and back and forth we go, we will not settle that here. This part of the segment, though, has to do with, okay, what explains why so much higher now? And it's very difficult to say, but let me just say that, there are a couple of things. Number one is because of what I've described, which means limited supply. That marginal buyers, by marginal I don't mean like questionable buyers. I mean, an extra buyer for any asset can increase the upward price pressure dramatically. And we have evidence of that. And these headlines do matter in that sense. And here are a few groups. Number one is you've got companies taking their retained earnings from their treasury departments, which was in cash, and converting it into cryptocurrency and sitting in their treasury. Now you can understand, right? I mean, this is not just some rich dude, putting $1 million into Bitcoin. This is $100 million a crack putting into Bitcoin. Okay. So now you've got, like I said, constrained supply. Well-off, credible, well-off buyer. Okay. So now you don't need to know too much more. I mean, just use your common sense, right? If the richest family decides to move into your neighborhood where there's a fixed housing ordinance and he's a buyer, guess what? Your house just went up in value, period. That's just it, right? No one added a bunch of, changes or modification to your house. The price just went higher. The other issue then is that as a result, you see the ripple effect, right? Because it's not just one company, it's multiple. And as each one is bigger, and then the price pressure on your house in your neighborhood has increased exponentially, right? And basically that's what you've got here. You've got PayPal, using it as a possible way of using it as a mechanism for payment. In addition to that, you've got companies putting their treasury money in there. So you have viability plus institutional viability. The reality is this is not in the 8th inning here. We're not even to starting the game. We're at the warm-up pitch level. Right? So as a result, if this were the only factor here, you could have demand continue to go higher. Right? Because since the cryptocurrency doesn't have, an inherent value, it only has a price. It's got no function, right? I don't get to melt Bitcoin into jewelry, for example. But as a result, what ends up happening is that you do have the fact that large, credible buyers can enter the space, and there is evidence of that today. The previous segments were really building the case on, so that you can get a feel for the rationale here about, because I know the headlines are always price. Of course it is. So the reality is 3 months ago, was it 3 months ago? Yes, 3 months ago, Bitcoin was $10,000. It is now $27,000 today. Okay, that's less than 3 months. And the previous segments were really about, whether or not this is actually viable. And nothing that I've stated here is untrue. And those are big, viable items. Big. Right? So in other words, the idea that this is driven by, Robin Hood investors or some guy, who decided to plunk down $1 million for himself and that drove, no. That is not, for me, those are the war stories or fairy tales that you might hear. And those are not necessarily going to be wrong. I'm just saying that that's not big enough to have driven the price like this. What I, however, said about the underlying economics, and then on top of that, the larger buyers actually existing. Absolutely. And I didn't touch basically yet on the fact that we have institutional investors who are also scouring the world for, how to make money. So as a result, nothing here tells me that this is fake. Nothing. Now, just because it's not fake doesn't mean that, it's time to convert, 25% of your net worth into crypto. Okay. So what I'm going to do here is talk about, who might buy and why they might buy. And let's step back here, because the reality is that whenever I'm dealing with financial matters, you're here. You kind of know the story, right? I'm starting with where you are trying to get and when that time frame is. That becomes first. What are you trying to accomplish and under what time frame? And you can understand why. Right, for a 30-year-old with spare money, does some amount go to Bitcoin? Yeah, probably does, given what I've just described, right? In other words, I don't see those two forces, going away. And at some point over that person's next 50 years, the likelihood is either much, much higher prices or some calamity on the macroeconomic level, in which case they may need to own Bitcoin. As a financial necessity, that some portion actually, if they don't, it could be negligent from, if you put yourself in my seat. In fact, that is the case, right? In other words, I didn't say, 75% of the 30-year-old's 401k goes into it. No. But to have zero also, there's risk involved by being left out. And to a 30-year-old, actually, the risk is that you own zero. That is absolutely the case. Now, and it changes, right? You can see that I've made an extreme example intentionally. I'm 80 years old. I'm 80 years old. I have more money than I know what to do with. I can't use all this money. And I'm going to give it away to my grandchild. Well, you're actually no different than the 30-year-old. Weirdly. Right? If the point is here that the money is going to, a 7-year-old, a 10-year-old grandchild, you could absolutely build the case that Bitcoin is absolutely in order. Now, I did not say, again, we're going to get to common thread here later, right, which is size matters, right? I did not say 50% of the 80-year-old net worth for the 7-year-old grandchild. No, I did not. But you can see what happens is based on your financial situation, the actual risks you're taking, there's a risk of being in. There's also the risk of not being in. Because if you understood the segments that I mentioned prior to this, I can absolutely build the case that the 7-year-old has to have some of this stuff at some point. And so now then it's up to you, grandparent, okay, what's the amount that I actually need? We'll get to that, in future segments here. Okay. So here's the tough thing now, right? We're here today. Crypto, let's say Bitcoin, the benchmark, 27,000. And there are a bunch of other cryptocurrencies out there, Ethereum, Ripple, etc., and we'll get to some of the risks. The issue is then how to enter, how to actually enter, right? And this is going to be very, very tricky because at this point here, right, you're talking about an asset that's gone from 10 to 27 in 3 months, okay? And even if everything that I said was correct, which is not necessarily a guarantee, but let's say the prior segments you believe in full, there is nothing to stop it going from 27 back down to 10. Now, I doubt it. Why do I doubt that? Because, like I said, because of the publicity and the highlight and the developments of companies, big buyers, big new rich family moving into the neighborhood, I don't think they're going away. Right? So in other words, do I think we're going straight back down? Well, there can be events that would do that, but do I think necessarily that we're going back down to those levels and you're waiting for that? I doubt it. I doubt it. That I can be absolutely wrong on that, but it's not looking like that at all. This is, however, though, then kind of a question of entry, because the fact of the matter is that like any investment, any allocation of money, you're talking about timing being an element, and without being overly wearing out the timing is everything. I would not necessarily call that the case, right? But in this instance, the combination of your age and circumstance and your objective here will matter to whether or not you're buying crypto here at you're buying Bitcoin here at 27,000. Okay, because of the fact that, and I'll try to give you some broad ranges, and we'll go from there, and then we're going to wind it up by, what are some risks here that we still need to consider. So now you're a millennial, right? You're 20-something, 30s, early 30s. You almost have to buy crypto. I didn't say for a large amount, but for some non-zero amount, that is probably the case. You put that money into a coffee can, if you're the watcher, if you're viewing this video now and those persons are in your audience, the people you care about, that absolutely is the case. If you're putting money aside for the use of a young person, again, some small amount absolutely makes sense. And as a result, you are kind of price insensitive. Because of the fact that that's your horizon, therefore you are time insensitive. You are price and time insensitive. And if you have not bought by now, even though it has ripped higher from 10 to 27,000, that's the bullet that you bite. Does that mean that it can't go back down to 15,000? No, it doesn't mean that at all. But it doesn't change those financial facts. It doesn't become a factor here. Okay, so that's your first segment. The far harder here is going to be on those persons who have some savings, working, either self-employed or at a big company, but in middle age. My age division here basically has, a very dicey, wildly different set of possible paths here. Because the fact of the matter is, for my age division, for example, an entry point of $27,000 per Bitcoin is high. I've sat here looking at it at 10. In fact, I sat at a lunch with some friends and they said, this 10's probably worth it given, the prior segments. And full disclosure, I do have some in spurts, but nothing substantial and largely for recreation and information gathering. So I don't really have a big allocation. That said, part of the reason is because of the fact that You can't just tell a 50-year-old, a 45-year-old, plunk down a substantial amount here. Because can this rip down by 20, 30%? No problem, right? Because 20% on, at $27,000, right? It's only $5,000-$6,000. That could happen tomorrow, right? So in other words, the volatility here, up and down here, may be too large to stomach. And for those persons whose horizon are, okay, well, I need this for emergency money, or I need this for, some other allocation, or I may have to use it, in the medium run. The ripple effect then becomes, okay, how much can I afford? Right? In other words, I know it's going to be volatile. You should presume it's going to be volatile. There are going to be headlines. There are other risks that I'll end this video with. But it's dicey here. Size and timing for this middle section of people, which is going to be the majority, is going to have to be more careful. You're going to have to be careful. You just cannot plunge in with 100% of your allocation here at the high. Right? Yeah, I think Tesla, that the electric vehicles, probably run the world at some point. That doesn't mean that I just go up and click the buy button on Tesla at these prices. In the same way, the difficulty here on these cryptocurrencies is the fact we have no historical precedent about the way these trade. Okay, so if you put on my other hat from, prior lives, right? I mean, I would have some idea about, and the day traders in the S&P futures markets, the professional traders, they know how many buyers of S&P futures at a particular price on a particular day. They know what the population of buyers look like. They don't know the identity of the buyers. They don't care. What they do care about is how many people bought at S&P 500, 3600. They see how many contracts traded there. The issue is you can't translate that to crypto. We don't have we've got no benchmark here. We've got no way to measure how many buyers at what price. This is why you cannot just plow up 100% of your allocation. I don't care if that allocation is $10,000. I wouldn't plunk down $10,000 at the existing price. Could you be left out in the cold, meaning that, the next price is $36,000, not $27,000? That is a risk, no question. So as a result, it's very likely that a layered approach is, going to be required, because of the fact that we don't have the traditional ways of measuring volatility and price action on given assets. We have this data in almost every other class. We have it for gold. We have it for General Electric stock. We have it for ExxonMobil. The owners of ExxonMobil don't want me to remind you. Apple. We absolutely have, the professional traders know how many shares at what price. In other words, they have a track of, hey, have the rich families moved into the neighborhood or not? They know. They know. You don't know because you're not following it, but they know. And they know that, well, the rich guys have sold and they've sold too soon, so we're a buyer, et cetera, et cetera. And how many new substitutes? They absolutely do know that. That data is out there. That doesn't exist in crypto. This is a very specific risk here on cryptocurrencies that needs to be taken into account, and why again, back to my bottom line here, for this largest segment of possible buyers is why you just don't plow in your total allocation right here. Okay, so now let's say you're retired. Let's say your retirement age, and again, multiple different layers. If you're retired and you plan on giving your money away to charity, to your grandchildren. Yeah. I mean, it does make sense in that some amount. In some amount. They're taking the price risk. Yes. Right? So, I mean, you can understand to charity, this is not that difficult. They're taking the price risk. You're gifting the money. Fine. You get your grandchildren slightly nuanced, right? More nuanced. They need the money for college expenses, and that's going to be their main source. Okay, now some amount into crypto and some amount in other instruments is probably best. Some combination. Again, kind of not plunking down the entire amount into crypto. Now, the reality is, and people who know me know this and who have followed, the comprehensive financial planning, is the best leverage is not going to be in financial markets. The best leverage is life insurance. Make no mistake, right? Per dollar, best return on investment for some portion does become life insurance for a variety of reasons. And, oh yeah, by the way, we'll have another video about how that is going to get tougher in the age of COVID. You can book that one. Okay, let's just continue on here. So now you're retired. If you're day trading for kicks, I'd probably stay away. I mean, unless you're turning on your computer for sport and for fun, yeah, you can buy half a Bitcoin just to say, for cocktail party talk. Okay, that's dabbling. Any real substantial number, because all the scenarios that I talked about at the beginning, right? Dollar devaluation, hyper, currency war, etc., etc. The reality is that you're probably going to get enough kicking the can. I mean, we've kicked the can down the road to this point, right? And if you're 80 years old, so unless you found like the solution to life where you're both going to be physically more capable and also live to 120, are you really going to be seeing the full-out currency war? It's not likely, right? So as a result, do you really have to hedge against that? No. So what's your allocation to crypto? Probably not. Like I said, unless you do this kind of thing for sport. If you're doing it for sport, then you should have already been in, right? You should have been in and watching it, plunge down to 4,000, where it has been 4,000 within the past 12 months. Okay, so again, this has to do with age, what you're doing with that money, what your objective is with that money, and then working backwards then, once you add those two together to get to your allocation. By the way, if this looks and feels like the comprehensive financial planning package, there's a reason for that. It's exactly the same method, right? I mean, it's exactly. There's no shortcut to the process. We're changing the label of, this, that, or the other. You can call it stocks or bonds or annuities or insurance, et cetera, et cetera. The same process to evaluating it, almost irrespective of the topic. Wax on, wax off, basically, right? Okay, so now let's say you're retired. Let's say your retirement age, and again, multiple different layers. If you're retired and you plan on giving your money away to charity, to your grandchildren, yeah. I mean, it does make sense in that some amount. In some amount. They're taking the price risk. Yes. Right? So, I mean, you can understand to charity, this is not that difficult. They're taking the price risk. You're gifting the money. Fine. You get your grandchildren slightly nuanced, right? More nuanced. They need the money for college expenses, and that's going to be their main source. Okay, now some amount into crypto and some amount in other instruments is probably best, some combination. Again, kind of not plunking down the entire amount into crypto. Now, the reality is, and people who know me know this and who have followed, the comprehensive financial planning, is the best leverage is not going to be in financial markets. The best leverage is life insurance. Make no mistake, right? Per dollar, best return on investment for some portion does become life insurance for a variety of reasons. And, oh yeah, by the way, we'll have another video about how that is going to get tougher in the age of COVID. You can book that one. Okay, let's just continue on here. So now you're retired. If you're day trading for kicks, I'd probably stay away. I mean, unless you're turning on your computer for sport and for fun, yeah, you can buy half a Bitcoin just to say, for cocktail party talk. Okay, that's dabbling. Any real substantial number, because all the scenarios that I talked about at the beginning, right? Dollar devaluation, hyper, currency war, etc., etc. The reality is that you're probably going to get enough kicking the can. I mean, we've kicked the can down the road to this point, right? And if you're 80 years old, so unless you found like the solution to life where you're both going to be physically more capable and also live to 120, are you really going to be seeing the full out currency war? It's not likely, right? So as a result, do you really have to hedge against that? No. So what's your allocation to crypto? Probably not. Like I said, unless you do this kind of thing for sport. If you're doing it for sport, then you should have already been in. Right, you should have been in and watching it, plunge down to 4,000, where it has been 4,000 within the past 12 months. Okay, so again, this has to do with age, what you're doing with that money, what your objective is with that money, and then working backwards then, once you add those two together to get to your allocation. By the way, if this looks and feels like the comprehensive financial planning package, there's a reason for that. It's exactly the same method, right? I mean, it's exactly. There's no shortcut to the process. We're changing the label of, this, that, or the other. You can call it stocks or bonds or annuities or insurance, et cetera, et cetera. The same process to evaluating it, almost irrespective of the topic. Wax on, wax off, basically, right? So this is not riskless by any means. And there's going to be price risk, which I'll call short-term risks. And let's just call it, there are going to be systematic risks, which are bigger ones. Okay, I don't think there's any doubt about that. Short-term, of course, price risk is, now elevated, notably elevated, right? Which is that, you could have certain issues in the headlines push down the price in a real way. And here's a headline, because Ripple, XRP is, Ripple is a cryptocurrency, and you can see it has plunged. It is not a small, so there are all these cryptocurrencies, right, which is that, the nerds have basically created their own technology and say, hey, look, we can just create a cryptocurrency. Okay, well, and at this point, there are a few larger ones. Ripple, I think, is one of those, and it had its own payments system so that you can make cross-border transactions using Ripple. And not only that, their kind of platform for transfer. Well, this headline came across the other day, which is the SEC has sued Ripple. And they are saying, look, this is actually a security. This is a security. And as a result, you've not filed correctly for the security. And now you can see the Ripple price has plunged, and not to recover. It has recovered from the low, but you can see here that it is getting crushed when it compared to Bitcoin and other larger cryptocurrencies. This type of system, do I think this is going to happen? No, not necessarily. This could be Ripple specific, but what it does highlight is the general principle is that as crypto gets more credible with the rich guys in the room, or the rich, families moving into the neighborhood, the amount of governmental scrutiny is going to increase. I think there is no way that you're going to avoid that. No way. This is a systematic risk. In other words, there's nothing to stop, for example, the United States or the ECB, et cetera, to say, look, you're never going to have this be an actual substitute for the US dollar or the euro. And the big central banks, the central banks of the world, they have motivation to do this. You cannot get around that. I don't see that you get around that. There's a reason that crypto has been used for illegal financial activity, right? Because since it's not going through a bank and yet still is secure, right? You can money launder and be sure to get your money. That's absolutely viable. Do the governments, however, not because to shut that down, but really what it is that if crypto threatens the US dollar as a store of value asset or currency, the path to hyperinflation just speeds up. So you could possibly have this. And does this keep me awake at night today? No, it doesn't. Is there any barrier from this? Not really. You hear rumblings about regulation on crypto. And you saw a headline hurting Ripple notably. The number 2 of these is kind of related to this first one, which is the central banks could also simply create their own electronic currency. You'll see this, that various central bankers talking about this, and not dummies, big influential ones. We're not talking about Central Bank of Timbuktu. That all said, do I necessarily think this is the one? I don't. Just introducing the extra currency, if it's at the central bank level, probably isn't, right? Because that's just introducing another euro or introducing another US dollar, right? Because if it's a central bank who's doing it, again, they're going to be motivated to just keep hitting the print button. They printed dollars. Why don't they just print euro currency? Right? Or US dollar. It just happens to e-dollar or e-euro. Right? In other words, the same things that Bitcoin currently addresses also would address a central bank created crypto. So as a result, that's not the one that keeps me up. The first one does keep me up. The first one meaning that the central banks, that the government authorities could say, look, if you're a legitimate business, you can't do X. You can't transact in Bitcoin. Right? That could occur. That could absolutely occur. And I could tell you what the rationale would be. I can't track the taxes correctly. Bingo. Right? I mean, there's nothing to stop the IRS from saying that. Not really. We're going to see this. So that one is viable. The second one about about the central banks creating their own cryptocurrency to be competitors to Bitcoin. No, that's just saying that, that's just different type of transmission, a secure transmission, which already exists by Bitcoin, and the supply is constrained by Bitcoin, whereas at the euro or the US dollar, for example, or yen, there's nothing to stop the Japanese central bank from just keep hitting print. So that's not really the solution. Anyway, that's it for the big risk, and then of course, there's the technical risk, which was mentioned before. The short-term risk, very, very high, just because of the fact that, the price has risen to this degree, and we have no real great data about the way who is accumulated at what price and at what size. Okay, everyone, I think that's a wrap, which is that, without making a 6-hour video, I'm sure the video is already too long for many, that this is real. It's not going away. Can it be an asset class in your, financial plan? Does it have a place? That depends. It always depends, right? You'll never hear me say this should never be bought, or this is always terrible, or this is always must have. There's no must or never. Those are not terms that I use. Wolverines will never win a national championship. That's probably closer to the truth. But you understand my point. Must and never. No, I wanted to address and give you some highlights about what crypto is. Do I think it's going away? Why do I think it's not going away? But then critically, how you may want to think about it and whether or not it fits you. Send me emails and questions. Be sure to subscribe to this part of the channel, because I'm going to be posting up videos here, and some of the time I'm not going to have time to send you an email to tell you that it's even posted. That's largely because I'm busy, and creating even that email to blast it and to tell you takes time and things like that I may not have. All right, Happy New Year, everybody.